Hi, welcome everyone again to another financial analysis video and sales analysis video with myself, Moeed Amin, and my colleague, Ted Wayman. So today we're going to be looking at a really cool company, Walt Disney. Now, most of you are probably thinking, well, they don't need much of an introduction. And you're kind of right. Everyone probably knows who Walt Disney and Walt Disney Company is. But actually, there's a lot of information around this business that may not be so well known. So we'll dive into that. But look, Walt Disney, massive company, global business, involved in entertainment, media. They're headquartered in the US. Now, what's interesting about this company is they own over 200 companies in their portfolio. And I found this infographic on a Google search, which I thought was incredibly interesting and almost encapsulates the complexity and the reach that this company has. They own companies in, obviously TV, movies, various forms of entertainment, video games, even cruise lines, right? So they really have a pretty broad portfolio. Now, this was a request from one of our viewers. And quite a detailed request, as Ted and I were just talking about this earlier, quite a detailed request. And we like detailed requests because it gives us a bit of context behind, why you're interested in us looking at this business for you. And we can slot that into our analysis. So thank you, Aston, for your request. And for everyone else as well, don't forget to like, share, subscribe, leave a note in the comments section because, a lot of our videos come from you and your requests. And we will do our best to publish that video and that analysis. But do leave a note and make sure that you subscribe because if you're a subscriber, you will get instant notification of when we release that video for you. So before we go into the finances and, the numbers are just mind-boggling. And I think the last time we had that kind of size of numbers that we were looking at was when we were looking at Amazon. So you could probably click on the link coming up now if you want to look at that video as well. But just look at the share price. So went public in 1982, just over $1. I think it was $1.06. Now it's at $135. But if you will zoom in and kind of look at a year ago, in the last year, the stock was actually down from when it started. So we will have a look at that share price as part of the analysis. We're not here to give you financial advice. We're not here to help you analyze whether you should invest in this company in the future. The purpose of our show and what we're doing here is to help improve your financial analysis skills, right? As Warren Buffett says, finance is the language of business. So if you cannot speak the language, you cannot really do business very well. So that is what we're here to do. We're not here to help you do your thesis on investment or any forms like that. So Ted, let's share what we've analyzed about this company. Really, really interesting business, I have to say. So looking forward to this one.
It is. So good to see you, Moeed. Yep, thank you very much. And just once again to reiterate, always nice to get a nice detailed explanation as to why somebody wants to have a look at the company rather than just, can you have a look at this company? So here we go, Walt Disney, the House of Mouse, as it is well known. And these are the financial statements for the fiscal year 2021. It won't be for the whole of 2021. It'll be for the year ending in 2021. This is the financial report. This is available on their website. You're looking for the 10K if you are looking for it yourself to download it. Lots of information in the 10K, but we are going to do a focus on the actual financials, and they are around about page 70. Here we go. So here we go, page 70 of 123. So we are looking at, this is the income statement. Interesting enough, actually, it doesn't say, they usually do, we'll just look at the financial statements. So this is up to the end of September. So you'll notice it says 2nd of October 2021. So this is, their year end is basically the end of September. So this will be the last 9 months of 2020 and the last 3 months of 2020 and the first 9 months of 2021. Start with the income statement. Here's the income statement. So fairly comprehensive income statement, 3 years worth of information. At the top, we've got our revenue. Interesting enough, they split their revenue between the products and the services. So if we think about, the services will be things like, Disney Plus. You're going to have things like Disney, Euro Disney and the kind of, the theme parks, and the products will be, the actual physical products that they're selling as well. And you can see that, this is really a service company. Disney is all about experience rather than selling, stuffed animals, so to speak. And, look at the sales, pretty resilient. So, if you look at these sales, you kind of think, was there a pandemic at all? So little bit of a drop here in 2020, but really a pretty insignificant drop, and we're up at 67 billion of sales. So that's a 3% increase on 2020. Obviously, there was a little bit of a drop from the pandemic. And then we've got the costs. So these are the costs of providing the services and the cost of providing the sales. And you'll notice that the services cost compared with the services revenue, that's about a 60% cost, so it's about a 40% gross margin. So much more profitable, those services. So services, bigger part of the business and a much more profitable part of the business. Okay, and if you're interested, Moeed mentioned Amazon. Amazon's a really good, interesting as the sort of the other way, where Amazon, again, their service is much more profitable than their trading, but their trading is by far the biggest part of their account. We then got the selling, general and administrative. So these are kind of the costs of running the business, pretty consistent. And then we've also got the depreciation and amortization. So depreciation and amortization, often companies don't put it on the front of the balance of the income statement. These guys have, and the reason they have it is as a big number. They say we want you to be aware of this, and that is the depreciation of the assets that they use to provide those services. So if we think about the services, if they're providing, as we talked about, like a cruise, for example, if they own the boat, they've got to depreciate that boat. So that's where that cost is coming through. They don't actually explicitly show the profit or the gross profit, but effectively, if you take the revenue and deduct all of these costs, you end up with the operating profit, or EBIT. And so they're operating on about an EBIT of 5%. So that's not that high. Okay, so for big sales, it's quite a low margin business, and when we get down to the bottom, we're going to see that they're making effectively just a 3% net margin. So it's a pretty tight business to be in. They need to manage their costs fairly carefully. So just scrolling down a little bit further down the income statement, lots of interest here. The interest, not a problem. They're making a 3.7 billion operating profit in 2021. They're paying out interest of 1.4 billion. So it looks to me like they can afford their debt. But, you've been reading in the newspapers, inflation is taking off. If inflation takes off, interest rates have to be raised. And if interest rates double, then suddenly these guys could hit some headwinds. So, companies with lots of debt, if they've got a lot of interest and the interest is very high compared with their operating profit, they are going to really hate this new world of higher interest rates. And I think I was reading about the Federal Reserve looking at raising rates 5 times and possibly doing a 50 basis point on their next raise. What else do we see down here? So there's a little bit of tax. So they're paying out some tax. There's the tax charge. And then there's some other bits and pieces. So down the bottom line, profitable, 2 billion of profit, but not that profitable. Now, interesting looking at the profit. So if we look at the 2 years ago, 70 billion of sales, nice, healthy bottom line profit. They then do take a hit from the pandemic. And because of the nature of the business, this is a fixed cost business. So they don't talk in terms of gross profit because they sell basically services. So if you think about it, if you're running a theme park and you open up the theme park, it costs you pretty much the same to run a theme park if one person turns up or if 100,000 people turn up. And so this is really a fixed cost business, and therefore when the revenue drops a little bit, we see a massive drop on the bottom line. So it's a high risk business model from that perspective. As the revenue starts to come back again, we start to see the profits are coming back again. And again, if we can get this kind of profit figure here back to where it was 2 years ago, then there's no reason why we shouldn't be able to return that to a fairly healthy bottom line there. But at the moment it's a 3%, it's tight margin because of the fixed costs. So these costs all here, these are fixed costs, and that's the nature of their business. So this is a big volume game, and if they get it right, they will make a lot of money, but if they get it wrong, they will not. So there's our income statement analysis, giving us a feel for how they're doing. So I think sort of recovery mode is kind of the story coming through there. Come on to their balance sheet. If we look at their balance sheet, so in terms of their balance sheet, you remember on the income statement they had over 5 billion of depreciation. The reason for that very large depreciation is all of these assets here. So you can see the attractions, buildings, and equipment that they've got. That's the amount that they've already depreciated. So these are their parks, resorts, their property, etc. And there's also a lot of goodwill parked on the balance sheet, and that goodwill arises on acquisition. So we saw the slide that shows how Disney has grown. It didn't get there through organic growth. So Disney has grown by buying very good brands. It'll buy Marvel, for example. It's buying those brands, Star Wars. It pays a very significant premium for those brands and effectively plugs them into the House of Mouse operating system, so to speak. So total assets, $204 billion. So very, very big. And most of those assets are all either basically the assets they need to run their services, or they are the goodwill based on acquisition of additional brands plugged into the overall House of Mouse. On the other side, we've got the current assets. This section up here. Current assets, as we'd expect, lots of cash sitting on the balance sheet. So 16 billion of cash, help them to ride out the storm. Some receivables, money which is due to them, and a little bit of inventory. So these will be stuffed teddies and stuffed Plutos, etc., waiting to be sold in their shop stores. Those are the assets. Let's go down and look at the liabilities. So here we have the liabilities. So jumping out at us are the borrowings. So as we said, they're making they're paying interest, so they've got debt. There's the debt. We add those two numbers together, so they've got the current portion of borrowings, and that's absolutely fine. It's a bit like your mortgage, for example. Some of that mortgage you're going to have to pay next month, month after that. That's in the current, payable within a year, and the rest of your mortgage, most of it hopefully is payable next year, the year after, and the year after that, etc. So there's the debt funding the business, and again that kind of makes sense. A company like Disney, they're going to expand by buying other companies, and they're going to debt finance that expansion plans, and also they are going to debt finance some of their investment in parks and boats and other bits and pieces. Down the bottom is this is all the equity, this section down here. So the total equity, 93 billion. So we're just comparing that 93 to the total of 203 and kind of give you a feel for how they're actually funded. So the non-current liabilities is a total of 80 billion, 93 billion of equity. It's a kind of 50-50 balance. Retained earnings, so most of their funding is coming through retained earnings, reinvestment back into the business. They've got a little bit of treasury stock. This is own shares held. You'll notice that hasn't changed because they haven't been buying back their shares for obvious reasons. And there's a fair amount of investment by the shareholders, initially 55 billion. So really, this is kind of made up of investment by the company and by profits being reinvested back into the business. So balance sheet looking reasonably healthy. Just to do a quick liquidity check. So we're just going to compare the current assets, there's the current assets up at the top, 33 billion or 34 billion, that's this number here, and we just double check that against our total liabilities, and we see that, you know, liquidity doesn't look like an issue for them. And again, don't forget that this number here, this is probably going to be refinanced by them anyway, so they're not looking to the current assets to pay for their debt. And therefore they just need to be able to make sure they can pay their suppliers 21 billion, and it looks to me like they can. So there's no kind of obvious liquidity problems jumping out at us there. We got the cash flow. I could come back to cash flow in a minute. I just wanted to just look at the movement in equity. So this is the you know, really where we can see what they're doing with the profits. So a couple of years ago, you'll remember, they made 11 billion profit. They've paid out a 3 billion in a dividend, and they've also written off a whole lot of their treasury stock. So effectively, they kind of taken the hit through there, and that was kind of a clearing out process. A couple of years ago, they then made that's where we're going to. So they then made a loss, if you remember. So there's the loss they made a couple of years ago. And they still paid out a dividend, and then they made a small profit in this year, but you'll notice there's no dividends. So as a result of the pandemic, there's a little bit of kind of retrenching, pulling back, no dividends just for a little while till we sail through, make sure that we're clear out the other side. Pandemic is sort of, you know, getting a feel that we're kind of opening up and we're starting to live with a virus. And therefore things should start to return to normal. And if you are invested for dividends, we would expect to see those dividends coming back reasonably soon based on these numbers. Here's the cash flow, and from the cash flow basis, really nice cash flow. So here is the cash flow from operations, and you'll notice that kind of underlying the fundamental is that these guys are generating cash. So yes, they may be making booking losses previously, but they are generating cash. They're generating cash pretty consistently, and that is a good thing. We like companies who generate cash. Investing. So here's the investment going on. So investing in the parks and resources. Now, always interesting to compare that number that I've just circulated, and I'll just clear my annotation and just bring this up. So it's always interesting to compare the investment there, the investment basically in capex, and to compare that with the depreciation. So this number up here. So in theory, if you're depreciating your assets by 5 billion and you're only investing 3.6 billion, then there's a little bit of underinvestment going on. But that investment and amortization will include amortization of the goodwill, for example, and the trademarks that they have purchased as well. So not a million miles away, but always worth just double checking on your cash flow to make sure that the company is investing sufficiently in the business. And then finally here, we've got the financing. So we'll notice that in this year, they've reduced their borrowing. So they kind of, you know, felt a little bit too much debt, especially with the kind of the pandemic. So it was increased in the previous year, probably in response. These numbers here, you can see this is the refinancing going on. They've been paying out dividends, but the dividends they've effectively reduced down to zero, again as a result of the pandemic, and we'd expect those to come back again. So they've actually used cash in financing, whereas in the previous year they were very much raising cash from financing. So those are some of the key numbers. There's nothing really that kind of jumps out at us. Otherwise, as I said, you know, the interest, they can pay their interest pretty comfortably. That doesn't seem to be a problem. You know, they've got a sort of a reasonable return on capital. So their return on capital, you know, is well, it's only 5%, but that's probably a reflection, you know, on an EBITDA basis of the fact that they are, you know, that they're quite low this year, and we'd expect from 2000 and if they can go back to 2019, that return on capital will actually start to rise. And I think that's really the kind of the big challenge for someone like Disney is, you know, they're profitable, but it requires a huge amount of investment in order to kind of generate that profit. And I think back to the kind of the days when they started Disneyland Paris, for example. It was almost a white elephant. There's a huge amount of investment, and people say people won't go there because the weather isn't that good, etc., etc. And it has been a success, but I think it took a lot of effort and a lot of oomph to get it there. So let's look at the share price and see how that has been behaving. Now, obviously, the sort of the caveat is that we are looking backwards at what's happened in the past, and the share price is an indication of what the market thinks is going to happen in the future. So if I obviously knew what was going to happen in the future, I wouldn't be sitting here. I would be retired by now. So we can see, so here, very obvious, the sort of the big drop. This is 2020, so this will be the drop in Disney. Just like everybody else, they go, oh, it's the pandemic, they have to close all their parks, they're going to make a big loss, and then kind of everyone treats it as a buying opportunity at the bottom, and then Disney suddenly races up. Now, I reckon that this peak up here is suddenly it's the pandemic, everybody's at home, they're subscribing to Disney Plus, great opportunity, and suddenly everyone's thinking that actually Walt Disney, if you look at it from a park operator, it's going to be a loser in the pandemic. If you look at it from a Disney Plus online streamer, it's going to be a winner from the pandemic, and so you see a big upside here, and then people are going, well, hold on a sec, actually I think that it's because of the parks being closed, it's going to be a loser as well. So where does that go next? Well, if we kind of just clear those drawings, we take a bit of a sort of a long-term view, you can kind of start to, this is the chartist's approach, and these are what you might call kind of levels of support. Not necessarily saying that it doesn't necessarily carry on all the way up there, but you do get a sense of that there's been a correction. Walt Disney, the Disney Plus channel, the pandemic really good for Disney Plus. The question is whether they can hold on to those viewers. So we think about today, and if you're a subscriber to Disney Plus, maybe you're a subscriber, maybe here in the UK we pay a BBC license fee. Maybe you're a Sky customer, maybe you're a Netflix customer, maybe you've got Disney Plus, maybe you've actually subscribed to YouTube as well. Suddenly you've got all of BritBox and there's so many subscription services that at some point people are starting to go, hold on a sec, I'm spending, I don't know, 200 quid a month on these subscription services. This is crazy, I can't watch it all, I need to start whittling that down. And so Walt Disney very much promoting the fact that what you expect to find on Disney, but also what you don't expect to find on Disney, and really trying to muscle in on Netflix. And that's really where they see their future, where they're trying to get to, and obviously Amazon Prime, etc. Alongside that. So in terms of the market cap, it is quite high. So we're looking at a price of 246.5 billion. So that is 122 times earnings. But the reason that P ratio is very high is that the earnings figure is very low. So remember that if they can bring it back to to 10 billion rather than 2 billion, suddenly that P ratio becomes not necessarily cheap, but much more reasonable effectively. So if they can get their earnings back to where it was in 2019, then there's no reason why that P ratio shouldn't come down to round about kind of 20 to 30, and that appears reasonable, although kind of at the top end of reasonable, which a lot of people in the market are experiencing at the moment. It's trading at a premium to its net book value. So net book value of 93 billion, that's the equity in the business, and so 246 billion is 5 times net book value. Sorry, 2.5 times net book value. So there's quite a lot of inherent goodwill in there, and obviously a lot of that net book value is in itself goodwill from the brands in there. So I think that Walt Disney, from a pricing point of view, it's not cheap, it's not a screaming buy. But then if we look at this chart, it's been pretty consistent. So it is a strong brand. It's made up of strong brands. I'm not saying that they can't mess the whole thing up and completely destroy it, but it seems to have kind of, it's weathered quite a lot of storms. It seems to be a pretty good company, well diversified. It's a high risk business model with their fixed cost base, but as long as we don't go backwards in terms of the pandemic, then this looks like it looks it would be a reasonable to include it as part of your diversified portfolio. Let's put it like that, Moeed.
Yeah, interesting. And it's certainly a company that, look, it's been around for a very long time. So it seems to have staying power. They seem to be able to hire the right people, through the generations. So very interesting business. Interestingly enough, actually, and I didn't mention this before, and this kind of gives you an idea of, they probably know what they're doing in terms of the bets that they're making. But I think they're the only company where they have more than 6 films that has grossed over $1 billion at the box office. They're the only company to have that many, if according to my research. So they clearly know what they're doing. Will their earnings go up? Will their kind of profitability increase, which will make that P ratio a lot smaller, maybe more favorable? Well, we're going to see and wait and find out. So thank you for that, Ted. That was really interesting analysis. And do leave a note in the comment section. We'd love to hear from you, especially anyone that may know this industry very well and can share some insights for the rest of this community. So until the next video, thank you, Ted. Thank you, everyone else.
Catch you later, Moeed.